Okay, welcome everyone. Steve Lentz here with the Morning Market Huddle. It is October 17th, 2012. Presented material is for educational purposes only and should not be construed as personalized financial advice. Welcome everyone. Have a real good show. What we're all about here, for those of you new, is that we like to blend technical analysis with good option spread construction. We believe that by bringing the two together, we can obtain a trading edge. And so we're going to take the next few minutes to go through things in the broad market. We will look at the broad market and from a variety of perspectives, and that's what we call the S&P 500 press box. We've got the market from a standpoint of trend lines, channels, point and figure, Ichimoku, etc., and we put it all into a report card summary to try and figure out, if there's anything predictive going on as to what's going to happen over the next week or so. Then follow up with the previous trade that we looked at last week, in this case a bearish TLT spread. And today we're going to take a look at CMG. There's some earnings coming out on it, and the horizontal option, the volatility skew horizontally is pretty pronounced there. So we'll get to that after the market open, and we'll look at the live data coming in and try and analyze some possibilities there, okay? Finally, at the end, well, not at the end, it just depends how long this all takes, we'll take a look at the symbols you're interested in. If you're looking at a certain stock, ETF, if you could even give us the symbol, we'll take a look at that in OptionVue, look at the options, look at the chart, see if there's any good opportunity out there, okay? Excellent. Well, without further ado, let's go to the S&P 500 press box here. And, I'll just take the pencil. There we go. All right, now, this is somewhat of a big day, not a big day. We've been looking at the monthly candlestick chart for really weeks in the context of divergence, meaning that when price makes a new high, the indicator does not, well, that would mean some bearish activity coming up. But look at this, with this month's activity, in particular with yesterday's action, okay, typically this value of the RSI 14 is now higher than it was back at the peak before. Do we have that kind of divergence going on? All right. And so now we do have it technically from this peak to this peak. I can't tell from there to there, but the divergence in the most recent peak is not there anymore. Now, doesn't the market's not going to go down? It just means that this divergence is no longer the present. This one still is. Okay. I'm backing off on that bearish divergence call that we've been talking about for so long. And that's because you can see the current value there is higher than the close last month, and that's what negated this. That's what made this one go up higher. We technically still have a very long distance divergence, which still is divergence, meaning that, and what do we mean by that? What's the big deal? The big deal is that when markets go up, when a mountain, let me just say, if you're climbing a mountain and the top, usually what happens is it begins to plateau and then come down. And that's going on with the markets here. We have momentum coming up, some good strong momentum, and now it's kind of beginning to plateau, and then we'll see what happens. That's what this is measuring here, is the momentum or the steepness, relative steepness of the price ascension in this case. With that divergence, it's basically telling us that, hey, this is beginning to plateau a little bit. The momentum, the strength of the uptrend is not what it used to be. That's where we're backing off that a little bit because we had some strong surge here this last day. Let's go to the weekly. Go to the weekly. We have, let's see here, where are we? Okay, let me get my other pencil there. Okay, that's this. Get to go. Oh, I know. Sorry about that. There we go. Alrighty. What do we see here? We see somewhat, someone might say this is a flag, but it's just too volatile, in my opinion, to be considered a bull flag. All right? Bull flags meaning that you have a big, strong, impulsive move, and then choppy behavior, and then it breaks out to the upside again. It could still work out that way, but flags, I think, are a little don't stronger volatility going on like you see here, typically. But I want to show you here is some what we call hidden divergence, and that means, and this just happened here since we spoke last, the RSI came down below the peak made from August, and then when that happens, you got to look up here and say, did price do the same? Well, it didn't. Price did come down to the level of this peak right here, and that's an indication of bullish continuance. Divergence, meaning bullish continuance, and this all happened since we spoke last. Okay, that this came down all the way. So now is that you do have a bullish signal given if the previous bar is exceeded. So if the high of the last bar is exceeded here, well, that's a good signal to go long. Now this week comes and goes, and it hasn't done that. Well, then this week's high would be the trigger to enter long on the weekly chart here. And you would naturally have a real good little, stop loss, of course, below the low of the previous two bars, and so off you go. So it's just a signal that's occurring right now, is we have hidden divergence, a hidden divergence condition for continuance on the bullish side. Let me write this down. I didn't print out my report card. We'll get to it in a bit. But so monthly, and you might want to kind of just take your notes down too to get this. So on the monthly, okay, we'll have some divergence, but we're going to back off and almost to a neutral setting. On the weekly, we have divergence, bullish. On the daily, let's take a look at this. What do we see here? Now, what we have seen since we've had 5 days, which would be since last time we spoke. 5 days have occurred. All right. We were looking at a kind of recent trend line break. I'm going to show you that in a second. The trend line. Us for now. Now you see the hit is kind of distant from here to here, but the I made new lows. You see that? The I made new lows that corresponded well with price, but on a more distant here, it has, we have hidden divergence here indicating when that happened right here, with this big down move here, then the hidden divergence was in, the condition is in, and it's speaking to continuance on the bullish side. Quite honestly, that's what this is saying. Set that down as a hidden divergence bullish condition, and that would fall under the bullish side. Clearly, this area of channels, lines, etc. Amazing how, and we looked at this last week before any of this occurred. Okay, at the end of this, we're long-term bullish because we're in this big channel. Short-term, we didn't really know, but look how it came down, right, and scraped on the bottom channel that we drew last week. Look, make it from the points here and here. You can draw the points here and here. Look at this. It's just amazing how this works. And what you do is you take the channel, you cut it in half, and you have what's called an action-reaction line, where price attracted to and repelled from, that area. Price comes up to here. We expect it to kind of wobble around and possibly come down and stay in the lower channel here. If it bumps out, well, then it could stay in the upper channel. But if price, and it could happen between now and when we talk next, the downside happens. This is an important line here. If price comes down and you have a price bar in between the high and the channel, well, it's a pretty good indication that it's, we're looking at a whole different paradigm. We would now draw channels the other way. We would go to a bearish mode at that point. Okay, but right now, this is definitely bullish, ending upward. It gets chalked up as the bullish side. Okay, we're right here. Let me get rid of my, what did that? Okay, there we go. Perfect. All right, let's get a sip of coffee here, and we're going to look at some DeMark trend line setups for those of you that like that stuff. One moment. Trend line methodology says that we look at the last two isolated highs and lows, and he has some qualifiers there. So there's an isolated low, and then we look for the next lower. So we always start with the most recent one, and then work backwards. And we want one that is lower in value. So we go back, well, this one's higher, this one's higher, right here. There you go. And then we draw a line through it that way. They always begin on the right side. A lot of people looking at trend lines will come over here and go, well, let's see, let's look at this one, let's look at this one, let's look at this one. And you start on the left side of the page looking right. No, you always start at the most recent isolated low and move left. Now to the highs. Where's the most recent isolated high? Right here. Where's the most recent one that is higher? Okay. And then draw it that way. So these are the two DeMark trend lines that are currently in play. And what we do is we wait and see if this thing, if it's qualified or unqualified. Now, we have the market going up for 2 days. If all of a sudden today it breaks through down here, well, that's a good qualified break. That would attract the public. And that's what you want to really base this on is, does the breakout have the likelihood of attracting the public to it? And what you can do is look at the previous days to see. So last 2 days it's gone up, overbought, all of a sudden, bam, that would be, I think the public would be caught by surprise if it breaks through the trend line here today. Now, what if price instead goes down, comes off, and it goes down for 2 days, goes down one day, and goes down the next day and just scrapes on that trend line. Next day, if it broke through the trend line, that wouldn't really be that much of a surprise. It's kind of there would be some time frames that it's oversold at that point. That breakout would not be a qualified breakout. Okay, previous day to be an up day for there to be a qualified down break. Likewise, come up here, if today it busted out upside, well, we're kind of far from the trend line, but it might catch people by surprise and then bring it in, But the idea here is that ideally we want the market to go up and then have a down day before it breaks up. See that? And that's called the qualified or unqualified break. So that's where we're sitting right now on the DeMark stuff. Going over to point and figure here one moment. We talked last, we had a good significant bit of activity here, and this is in the area of a sell signal. We've had our first sell signal in the point and figure chart since since June. You point and figure aficionados, you see the last sell signal on the chart here. Okay, let me walk you through, before we answer, let me just take the beginners through this very quickly. We have 10-point increments on the grid. Every time price goes up 10 points, we add an X in a column of X's going up the screen. We have the market reverse 30 points, or 3 boxes, we draw a column of O's going down the screen. And have a 30-point reversal, or a 3-box reversal, the other direction, you then go to the next column. That way you go from O's to X's to O's to X's. One column passes the same column previous, you have a buy or a sell signal. Here we have a column of X's surpassing the previous column of X's. That was a buy signal. The little previous sell signal. One occurred right here, today, or just recently here. It surpassed the previous column of O's, go down the screen. So we are on a sell signal. The previous one occurred right over here when that showed up. That's June. 6 months is June, and that's what these numbers and letters mean. 1-9 is January through September, and we have A, B, and C for October, November, December. Now, you trade point and figure, and this pencils out. It actually backtests very well. To do that, you have to pay attention to the trend here. And this is the bullish trend line that is in operation right now. We are above the bullish trend line, so we're long-term bullish, but we're short-term bearish because we're on a sell. So anyone long would have gotten out using this methodology. It would be out of the market right now. You're trading long-term point and figure. Now, here's how this is work. If you're above the trend line, you take all the buy signals and you get out of the market on sell. And then you buy. So just watch this. Here you would have been long right here and would have gotten out right there for a small loss. Then you would have been long here and you would have gotten out right here with a small loss. They'd have been gain. This would have been a gain, so winner. Would have been long here and out here with a gain. So in the life, since signal here on the bullish side, we would have been in the market twice with winners. How is this going to flip over next time? What is on the downside? We have this column of O's come down and break through the trend line. Okay. And at that point, we would take every sell signal going down. Get out on every buy signal. And at that time, when that happens, we're going to draw a bearish trend line right here and operate on the sell side using that trend line. This assumes that it comes down here and breaks the trend line. Then this becomes our new bearish trend line, and we would operate under the short side then. Okay, so right now we're long-term bullish, short-term sell signal. Now, moving over, we have the bullish percent index. This is the a point and figure internals type of an indicator. One moment here. Let me clear my throat just a second. What this measures is the percentage of stocks on the New York Stock Exchange on a point and figure buy. On a point and figure buy. And we can see that number, it hit above 70 here. It's pulled 68. And it hasn't yet gone down, equivalent of 3 boxes for a draw 3 O's going down the screen. It has about 4 more percentage points to drop. And at that point, the bears would have the football. Right now, the bulls still have the football. Drawing this number up. Until it reaches, 80, we're not going to be too concerned. Once it hits 78, 80% or so, then the market top would be indicated here by a contrarian mindset. Now, the market can reverse before that, certainly. But on this chart right now, we show that the bulls still have the football driving this number up. Okay? Moving over to nonlinear. Different mindset. We're leaving the world of the channels and the trend lines and all that. Now we're going to look at the world of taking statistical extractions from price and to make heads or tails of it from statistical extractions. And this is just a great way of charting a philosophy here. It's called Ichimoku Kinko Hayo. In Japanese, it means equilibrium at a glance. Very quickly, for those of you knew, what it does is that it tees off on the notion of equilibrium. When the market goes up, the philosophy is it has to come down 50% of that swing, so that at that point, half of the participants are making money. Another half that got in late, losing money. We have equilibrium, that special place, the happy place. And then price can go in either direction. Here is that the market is moving away from equilibrium back towards equilibrium, away and towards in multiple time frames. And what we're looking at here on this chart, at a quick glance, we can see where equilibrium is in multiple time frames. And we're going to do that, get that kind of, crawl into the philosophy of, crawl into the psychology of the market. And then if you're a candlestick trader, it's even better. If you're into candlesticks, you know that all the great candlestick folks, especially those that are from Asia that do this, they say it's not enough just to look at a candlestick. You have to crawl into the philosophy. You have to crawl into the psychology of what happened with every candlestick. Every candlestick tells a story. And that candlestick's story in context of equilibrium. You kind of see where this is going? No, you don't have to light the incense to get into this, all right, although you may feel like it in this stuff. All right? So, here, the long-term equilibrium regions are these clouds. These are regions of long-term equilibrium. The algorithm for the borders is kind of complex. If you're above the cloud, you're bullish. If you're beneath it down here, you would be bearish. Right now, price is above the cloud. We're long-term bullish. Okay, now the shorter-term equilibrium are these blue and red lines. So the red line here represents a 26-day equilibrium point. So you look at the high over the last 26 days, you get the low over the last 26 days, and then the red line is. Now the blue line is a 9-day equilibrium point. 1, 2, 3, 4, 5, 6, 7. We have high here, the low here, and equilibrium is right here. Do you see how price came back up to equilibrium both in the 9-day and the 26-day? That's a 9. So right now, price is right on equilibrium. We're long-term bullish, short-term neutral. We don't know which way the price is going to go away from the shorter-term equilibrium. Long-term, we're now getting close to this cloud. When it gets in the cloud, it's arrived at an area of long-term equilibrium, and we just don't know which way it's going to go. It could go away. See here, sometimes it reaches equilibrium and bounces back to the same direction. But pure cloud traders trade the breakouts in the cloud, and it's a long-term trend following approach. Here's the last pure breakout of the cloud. Most people would still be long until price clearly breaks through going underneath. Long right now. Long-term, bullish, short-term, neutral. The volatility, okay? Looking at the VIX, VIX, the volatility implied by the cash options in the SPX. All right, low. But what we do here, and a lot of option people love to talk about the VIX. After all, if options are cool to talk about, derivatives, and you got volatility, and now you have now you can trade VIX in the futures. You could trade options on the VIX. There's even VIX of the VIX. It's crazy how far you can go here. So, in all research done on the VIX, and as much as people have talked about it, and I've been watching this for years, and I've been a skeptic in the use of the VIX for any kind of predictive powers. The one area of research I think has merit is on a short-term basis. That is when the VIX moves too far away from its average. And it does tend to revert back towards where it was. So you take a 10-day moving average here. That's the line here. 10-day moving average, and then you surround it with 5% bands. This was from Larry Connors, by the way. He's been through 2 or 3 iterations of VIX research. Years ago, Len Yates and I looked at his original VIX, teed off on it a bit, did our own follow-up studies and everything using some tools in OptionVue. Like Larry, we kind of came away perplexed, and then Larry did this stuff, and he came up with a real nice little notion here that if VIX goes down, that if the market is above its 200-day moving average, and in that environment, Okay? If VIX goes up too far above its 10-day moving average, that tends to be a real good predictor of bullish behavior. A real good predictor of bullish behavior when that happens. All right, it's kind of what we now hear this, but it's kind of have to started there and didn't happen for till later. Okay. But you can see when the market goes down and the VIX gets too high, that's when it kicks in and you're really ready to jump on bullish behavior at that point. All right. It's only good 3 to 5 days. I wouldn't get too excited going out beyond that. But right now, we have nothing predictive going on right now. Nothing on right there. I want to make sure I've got the report card on that, all right? Bear in mind, I don't know that I corrected that in the report card. So this we'll call neutral. Sure. On the notion of VIX, right, Len Yates created this indicator in OptionVue called the VIX diff. Teeing off on research done by Larry McMillan. Lots of Larrys out there doing options work. Larry McMillan had the notion that you take the VIX futures and look at the pricing between the VIX futures. So what we did is came up with some tools to kind of expound on this, called VIX diff. And very quickly, I know some of you have heard this a million times, I'm just going to come up here in this space up here, draw some stuff. In the VIX futures, you have month 1, 2, and 3. A front month is priced lower than the second month, and the second month is priced lower than the third. Now, when the market goes down quickly, the folks that are hedging huge portfolios rush in and start using the VIX futures to more efficiently hedge their long portfolios. And in that environment where the market's going down, the front month will blow up in value relative to the second month. When that happens, we have an indicator to kind of help gauge what smart money is doing with these front 2-month VIX futures. What we do is we take the second month futures minus the front month futures. That value, and we 15-day average of it, and that you see in this blue line here. If value is positive, we're above 0. If negative, we're below 0. See here is that we're definitely above 0. It corresponds to a thinking of smart money that things are they're in a bullish mindset right now. The front month is priced lower than the second. Now, that relationship, now see how the slope of the moving average is down? What's unusual is that it's getting less and less and less. It hasn't crossed the line yet, but the relationship is shifting. They're getting less and less bullish, even though the market has been going up, way upward. To me, there's a divergence there. And it hasn't happened that often. I have to go back and look at the life of this thing. It just doesn't happen that often. Usually, there's a correlation between the slope of the moving average and the market. So, term bullish, short term, there's some divergence here. It certainly is. I think short term, you have to look at a bearish mindset there. It hasn't happened that often, so we're going to just kind of watch that as it goes on. Here's the report card. There we go. Got the neutral thing there. Kind of a mishmash. Something here kind of struck your fancy in terms of where your market view is, but we have two hidden divergences going on here in the weekly and the daily. Bullish. You know, this neutral thing, I should have said there's less divergence. Less. And we would be looking at bearish. I'm going to less bearish. We're less bearish because less divergence now, but it's still marked in long term in the bearish area there. Okay, point and figure. This thing changed. We turn bullish, but we've had a bear signal now on the point and figure. So we're down on a shorter term basis. Stillish there. Ichimoku. We covered that. You know, well, I think you have to kind of look at it from the term bullish side. Longer term, we neutral thing going on. The bearish, less divergence. Well, I'm also concerned about this here too. All right, why is the smart money in the institutions, why are they slowly chip in these VIX futures? Over 2 months. Over 2 months, it's changing. I'm just, I don't know. I'm very intrigued by that. Okay, let's put our cap of a non-directional trader. I'm going to get a sip of coffee, and again, here we go. Just asking if it's a fiscal cliff. Well, could be. Could be. We haven't seen this much that you've had divergence for that long, but it's a new indicator. We're very, we only put this out in about April or so. We haven't been at this for a year looking at this, so it'll be interesting to watch, though. Election year, Lewis, perhaps. Oh, the election year thing. I think that there's just more. I heard someone say that people are very nervous about the notion that Romney would want to replace Bernanke, because in Bernanke they kind of know what they have, but you don't know what you're going to get if Romney's elected, and come January he puts someone else in there. Something to watch play. Maybe that uncertainty is playing into it as well. But honestly, that's not my wheelhouse. Even Graham, who's watching, he's the Economist cover to cover every week. I skim through it and read a few stories, but there's a few of you I know that are, deep into that kind of analysis. All right, let's look at the markets from the perspective of a non-directional trader. What are you looking at in terms of volatility? Let's just do a few signposts here. We have SPX, a market that is chronically overvalued. Over the last 6 years, on average, the time value in the options implies more volatility than what actually comes to pass. That qualifies this market as chronically slightly overvalued. You could sell premium neutrally in and make some good money. Now, to do that, this is the type of market that would be attractive for this kind of thing. Now, said, I do want to address the notion here that the markets are overvalued because the blue line is above the red, because implied is above statistical. That's what you need to look at. And this is what we cover in our mentoring course. The notion here that you really want to treat these volatility levels differently. Statistical looks last 20 days and tells you here the market is traded at a volatility of around 12. Implied is giving you a prediction of the future, telling you that that the SPX captions are predicting that over the next month or so, volatility of the market will be at around 14. Implied volatility looks to the future, statistical looks to the past. And you can't really say right now they're overvalued, because one is apples, the other is oranges. What we like to look at is the trendiness of statistical. Here's the deal. If you were to, look back here in August. If sold, you might have looked at it and said at this point, God, these options are undervalued. There's no way I would sell premium right here. Okay, right there. Let's take that data point right there. Let's say at that point you come and look, oh no, I can't sell premium because statistical is higher than implied. Bad market to sell premium in. No, look what happened. You would have sold premium here at a 13, and look up later and realize that during that month, this 20-day measurement here, the market had actually traded at about a 9. In a great market to sell premium neutrally in. What could you have known at this time that the market was a good environment? You would have looked down here at the Lentz volatility indicator and saw that it was flashing a huge thumbs up for selling premium neutrally. Now, what does this volatility indicator measure? It measures the trendiness of statistical. Statistical is trending down. That's good for selling premium, and I designed this thing to give us a thumbs up. Thumbs up, selling premium. It's negative, then it's a bad environment. That means statistical is trending upward like it is now. All right? This is a very questionable environment to sell premium neutrally in. And you could see with yesterday's move, boy, it really gave you a thumbs down here, didn't it? All right. Right now we have a thumbs down on the volatility indicator. What's going on here, and this is kind of disconcerting, as the market has been going up and chopping its way up, volatility has been going up as well. And now going down the last month, chopping its way down, and statistical is going up. That's a tough environment to sell premium in when statistical is rising, because it may turn out to be a month later that statistical kept going up and you sold premium much lower than what it turned out to be. So thumbs down right now. At minimum, cut your size. All right, go up farther on your condors. Give yourself more breathing room. Take less yield. All right, be more conservative. Don't put the pedal to the metal and statistical curls down and trends downward again. Okay. Now, before we get to the trade review and the Chipotle, quickly, I want to show you the mentoring program we have. Guys, if you are in the market at all for mentoring and you haven't been in our program, you got to take a look at this. We have a great staff of professional traders telling you, level 3, the same and techniques and principles they use to manage money on the accounts for themselves and their clients. Our staff manages money, and we mentor as well on the side, and we'll show you exactly the techniques and principles it takes to sell premium neutrally, and you can make the money, and no matter which way the market goes, up or down, we focus on volatility. That's level 1 or level 3, session 1 on vol. Of course, all levels we get into money management. It's a very important element in all this. Folks recently signed up for level 1 a bit because they need to learn how to manage their long portfolios. We show you how to do callers and covered calls and naked puts. Level 2 is directional spread trading. We give you some good technical analysis systems that blend in well with option spreads. Here are the Discover Options Level 3 Core Strategy return levels. Last month in September, we have a hypothetical account that we adhere strictly to a certain set of rules that we teach you. And you can see last month, both strategies did extremely well. These are the yield levels. You can have 2 losses in a row. That's true. No, but if you're at all interested in these kinds of returns, learning how to do this, give us a call. We'd love to see if what we offer is a match for where you're at, okay? So futures, we offer a one-on-one mentoring program for you futures options, folks. We take all our strategies, combine it up, and in the context of futures. Okay, we can take you through non-directional, directional, the Greeks, volatility, everything. Okay, now, non-directional candidates. Here we go, real quick. Pick out your pencil. Look, if you're going to do Google, you're going to do Intel, make sure you understand when earnings are coming out here. What we're looking for here are chronically overvalued markets where statistical is higher than, implied is normally higher than statistical. The last few years average. You want these options to be chronically overvalued, and you want statistical to be dropping, to be underneath its 20-day average. The Lentz volatility indicator, LVI, should be positive, giving you a thumbs up for premium selling. Okay, so no S&Ps on this. S&Ps, I think statistical took off again, and it took it off of the list here. It kind of wobbles around, but right is not on the list. Russell is, however. Going up TLT. What we were looking at last week. Nice channel. Right? Nice defined channel. It came down. It mostly filled in that gap and was bending down again, expecting a further continuance in the channel. We said to put on a bear call spread up here and get out if it broke through the channel here. And what happened? Bang. Shebang, and it came up. It went outside the channel and came back in. Oh, it can happen, can it? So what I did is I just showing you here. Here's where we were. We were attracted to this because of the real nice reward to risk ratio that we had. That if you're trying to make 40% on your money. Let's see. And on the risk side, we were trying to make it such that we would lose, half of that. So what happened? Well, at the moment that it broke through the channel, we said to get out. We would have lost roughly about 18, 19%. We lost about half what it is we were trying to make there. And this TLT thing, it in channels and all that, but boy, that's a bruiser here. Look at that thing. That just back in the channel, and then we would of course resize it, bending it a little bit so like it's going to stick in the channel after poking out there. Watching my presentation, decided to play a trick. Have you ever felt that way? Felt that way that there might be a couple trades you put on and does something like that, and you go, "Is someone looking over my shoulder?" I mean, really? I'd be the only one out there that feels that way. John says, every single trade I've ever put on. John, you've been around a long time. I don't believe a word of that. MG. I'm just saying, is this a good time to get back in? Oh, well, look at this. It's staying inside the channel with this. You'd have to go and you could sell 125 premium. Last time sold premium at 124. Is it a good time to get back in? I would analyze this from the boy, that's a good question, and I don't have time to dive into it. This is still TLT, that's correct. Loaded question, because now I would get outside the context of this channel and look at it from some other trend line perspectives going on. Another set of conclusions here. Okay, very quickly, and I want to get to CMG because I know earnings are, a lot of people like to talk about that, but real quick, because we did talk about TLT last time, okay, what I would do, in fact, I'm just going to go ahead and share with you my desktop and get OptionVue, dial up TLT, very quickly. And very quickly. All right. Okay. Let me change my moving averages. I'm going to take the model of Arnold's PPS system here because I see some trend lines developing here that are interesting. So he has 18 and 40 essential. Okay, and what we do here is we're looking at a triangle developing. Now, TLT gap down here past this thing. Is that what I'm seeing here? It gapped 21. Look at this. It gapped all the way down through this trend line. Okay, which is still a qualified breakout. Come on, Steve, this pencil. Here's the notion here. Price is below the two moving averages. We have a downtrend. Okay, I'll leave the channeling aspect because that we had that experience here. But I see this natural thing working up here. Here's the deal. we have a downtrend. It's below the moving averages. We have a triangle that is developed here. And when you have a breakout from a triangle, a good trend continuation. And open here. Look over here on the left. Right there. It's above the moving averages. Triangle developed. We had price break out of the triangle, and price continued up. That's textbook right there. Right now, this is a classic one. Now, you could jump in right now and go bearish. And as Arnold says, and I've traded this approach. It's fun. You got to take every breakout though, because they certainly don't all work. But any kind of a breakout like this, you can kind of play it consistently. And what we use the apex of the triangle as your stop. So you sell 123 premium on this to jump back in on today's action on the downside. Okay, what you would do, you would sell 123 premium. You'd have to come out to Nove and do this like that. It's through that apex. You can see you're trying to make 3 times what it is you can lose here. So that isn't too bad. Now, what did Jim say on CMG? I wanted CMG, and I wanted to do it live here. Earnings tomorrow on CMG. Tough environment on food change right now. And remember that Chipotle stores are 100% company owned, which does not allow it to withstand rising commodities costs. I'm going to read that again. In fact, I'm going to take Jim's, I'm going to pick for everybody to see right there. From Jim in our office, he is our operating officer, and he reads The Economist cover to cover every week. Look at this horizontal skew, and this is why I wanted to do this live. October. Okay. First, I want to bring up. Let's see. This is my football site here, so I wasn't to show you. What I wanted to do, but that's a quick aside. I was going to show you here because it was all put on, but someone while I'm logging in, I'm going to tell you about my football team because I got the phone call late last night that because we're in first place and we're going to play the second place team in our region, and out of 300 teams, the league authorities decided to take our game this Sunday night and make it the game of the week, and it's going to be broadcast on the internet. And so it's a big deal. It's a big deal for the kids. It's going to be at a high school on turf under lights Sunday night. It's going to be a huge deal for them. And me as a coach, they're going to have announcers in the booth. There's going to be a truck there with the cameras. It's going to be crazy. And so that site is where they're going to broadcast it. tcyfl.net. You can get the network thing on air, and it's going to happen. That's what's all going to happen. All right, Chipotle comes out with earnings October 18th, tomorrow at 4 p.m. after the market close tomorrow. I just want to examine this because last time, look at Chipotle, went down 18%. Wow. Previous to that, look at this. It's down 1%, 1%, 4, 3, 2, 3, 5, 3, 7, 3. You get the idea. Last time was a huge pop. Time was a huge pop, but look what pricing is going where it is now. What's going on now? The October month, obviously the one where all this action is going to take place. Look the next month out. The averages are in the mid-40s. Next one out, averages around 40, 37, 38. So when earnings comes out, our market close on Friday at the open, okay, all this volatility, the Octobers are going to plummet, Nova will plummet, East will come down. Let's say that the vol should drop to, say, 36. Looking at this, let's say 36. So we're going to model this. Price is going to get as if vols are going to get crushed down to 36. What can we do? Look at the price action here. Right? Let's go here. We have Chipotle. Look at that big 18% drop. It's clearly trending down and now chopping to the upside here. What's going to happen? Is this making a head and shoulders? It's going to, break through more on the bearish side. We have rising commodity prices. Jim sounds a little bearish, to be honest, on his process here. If I'm correct in that, Jim, you could certainly weigh in. But let's just see, if you're bearish, what it would take to make money on the bearish side of things. What could you do? You could do is that you could sell premium. We want to do something where we're selling premium here in October, taking advantage of the vol crush. Let's go happen. These 100 plus vol numbers are going to come down to 36 or so, lower in October. Okay, it's going to get crushed. So what can you do? All right. Well, what we can do is let's just look at this from a neutral perspective. Okay, let's just do an at the money. Well, let's say you're bearish. I said let's just pretend you're bearish. Okay, you could do a bearish butterfly, or a bearish. Okay, I'm just going to go to the thing that I would do. Okay, and I think that is that we want to. Let's go here. Let's come out. Let's out here. You could do a diagonal spread. You sell how many calls in October? Take 430, and for a net credit, come out here in Nove, come further out, and execute this so that you're doing this at a net credit. Now, you want to make sure your execution is done so that it's done at a net credit. Here we're going to have a 40-cent net credit. What is that going to do for us? Let's go to Analyze. Well, what I have to do here is make sure I got my modeling right. Be modeled uniformly at 6. I set the setting from variable to uniform. I'm going to reduce our model vol by 20%, by 0.1%. So when I click Analyze, I click Analyze. I have to come up here to the vol change and put in minus 20.1%. When I do that, I see that I have a break even. Yield levels here. Okay, and I am looking out to from now. That's correct, right there. And if this thing goes down, let's see here. If it goes down 10%, I'd only make 2% on the money. So this might not be the best way to go. Look at, you make more money if it goes up. There's OptionVue, folks. So let's do something else. Let's try doing an money diagonal. I think it's going to work better, and this is what we should have done the first time. Money diagonal. I'm going to sell, let's sell 10. Let's do a net credit, 1130. I need to come out here to this one. Credit, 10. I don't do that. I know that. We want to do monies. Should work best. We have a net credit coming in. Minus 20.1. Boom. There we go. Our break even is now. Boy, I need to get a microscope here. Just a second here. Percent to the upside. 6% to the upside. We make money down. No matter how far it goes down, we make money. We make money really in the sweet spot as to where it's historically been. If it drops down 2, 3, 5, 7%, we'll make 30, 40, 50% on our money right here on the bearish side. On the upside, it can go up 4, 3, 4%. We'd still make money. But if it goes up more than 6%, well, that's when we begin losing money. See, let's Jim weighed in here. Management already said that the extreme weather will likely put pressure on the company's food costs. until year end and well into 2013. So Jim is pretty bearish on this. This would be one thing you may want to consider doing, is an at-the-money diagonal spread in the calls at credit. And, you would want to put this on, of course, tomorrow near the close, because you want to see where the at-the-money is at that time. OptionVue, you could certainly analyze this and see how that. Now, what else can we do just for grins? I think we had a few symbols. I had solicited for symbols. It's just got term Bullish IBM. What else? Just quickly, and then I'll look at IBM, and that'll be it. Okay. What else can you do? Let's do a bearish here. Then you just come down. It's take a lot less capital. Come down here in the puts and put on a calendar near where you think it's going to go. Right? And you're going to look at this. We're between 3 and 12%. You can make a lot more money doing it this way. Now let me just show you the suppose right like that. So if you have a pretty good notion as to range that it's going to go down to, I would kind of look at this kind of a trade, the calendar, because you can make a lot more yield, of course. That is going to give you a lot more safety here if it does gap up. Yield, however, in return for that. So these were two strategies I would look at. We're going to get this diagonal spread. We'll report back to you next week on what happened with regards to the diagonal. LNX announces earnings after the close today. Jim, I looked at LNX last night, and I did not see an edge like we in CMG, where it has, actually it moves a certain level. NX, I think, typically moves a lot, and the options were priced such that they were kind of right in that same ballpark. You'd have to be directional to get an edge in MLNX. There's nothing neutrally that you could do I did see and I glossed over it, but Jim is saying that he's bullish. MLNX. Careful. So let's go look at MLNX, because LNX. I'll show you what I saw here. Let's come into here. MLNX. Look at this. 3%, 6%, 16%. Bullish. Huge moves to the upside. Jim bullish again on this. Let's see what the options are doing, okay? Oh, this will be fun. Next. Oops. There we go. All right, look at this. Month vols. Crazy. All right, let's do the same principle. Let's go in the puts. We're bullish, right? We're going to diagonal spread in the puts. Sell 10 of these. And so we come out to these are at 7, 10. Buy those. Oh, I didn't do the modeling right. I'm unavailable about that. Where's this thing going to go to after or come out? I think vol should drop to about a value of 60, say. So let's look at the settings here. Right now, operating on a 142, so we have to drop it by 82%. If all the options go to 60, when we model this, we're going to get down to 82%. Yikes. There. All right. Well, that's pretty good. If you put this trade on, we get it from yield. You could make 2% on your money, which it goes up, you have a cushion of a 14% gap to the downside. Crazy. Right? Wow. You're saying, well, gosh, why don't you just buy calls? Well, you know what? What are you going to do? Look how expensive these are. Let's go, and you know what they say to do if short-term, you're on something in the extreme short-term, what you do is you try and come as far in the money as you can. So let's just see here. What's the open interest on some of these? We'll come in the money. Just look interest on these. What if you came the money and you came to these 90s here? Let's just buy these, and I'm going to look at it from yield. Go. Here we go. Superimpose. We're counting 82%, and there you have it. Okay. Pretty much, if the thing gaps down, you're going to lose all your money on the calls. Okay, gaps down to the break even of the other one. The intersection occurs over here at a 13% gap up. If it gaps up less than 13%, clearly the down spread is the superior trade. If you think it's going to gap up more than 13%, well, heck, buy some in the money calls. That would be the best thing. If you think it's going to gap up 13, and just be prepared to lose the whole shooting match. Finally, IBM short-term bullish. Why are we bullish on IBM in the short term? Oh, come on. IBM enter. We're up 4% here. And gave us that prognosis before the market opened. Are you still bullish? Let's take a look. Oh my goodness! What was earnings today? What happened? I didn't. It was the computer to get my earnings list, and I just stopped at MLNX and Chipotle. Wow, that might be so. You're short-term bullish. Time out. Let's go take a look. I am earnings list, and I stopped at Chipotle and said, all right, that's what we're going to talk about. There it is. Last night, earnings down 4% already. After that gap, I couldn't. You can't do. There's no technical analysis to look at. If it clearly it went through gap. It gapped down. It gapped down to the trend line. Interest gapped down to the. Let's do the DeMark thing. Right here. Haven't do it yet. Yeah, you could sell premium right here. The trend line will then get out. Something would make sense if you're bullish. Premium at say 200. The premium can sell 195 or 200. Yeah. Just stay above that trend line and you're good. You're going to make 3 times what it is you're risking there. Easy. So that's probably a good trade. The channel analysis here, as you move along, it's already kind of it gapped down and is recovering. So that'd be what I would do, is something like that. But get out immediately after it goes through this. It might not bust through until later, in which case you could still get out for a gain probably. Anyone else? Okay. Folks, thanks for joining us. We will be back next week, same bad time, same bad channel. Take care. Bye-bye.